Silver at $84 with China out. The market has not seen Tuesday yet. While the world slept, silver moved. Without China, without the largest physical buyer on the planet, the price did not fall. It climbed nearly 9% in silence. And right now, sitting inside a vault in Shenzhen, a single physical bid is priced at $93. Western futures, $84. That gap does not stay open forever. Tuesday is coming. Shanghai reopens. And what happens next has never been seen at these levels before. The math does not close quietly. It never does. Welcome to AO and AG. If this is your first time here, take a slow breath, sit back, and stay with us. Now, a small request. The way you would ask your grandfather, please don't change the channel just yet. We are asking you the same. Hit subscribe, not for us, for yourself. So the next time something moves in this market, you are not the last one to know. You are the first. And one more thing, drop a comment below. Tell us, where in the world are you watching this from? Because this market does not belong to one country, and neither does this community. Now, let us begin. Every market has a heartbeat, and sometimes the most dangerous moment is not when it beats too fast. It is when it beats too loud in someone's absence. For one full week, China went quiet. The factories slowed, the trading desks emptied, the screens went dark. Lunar New Year had arrived, and the world's largest consumer of physical silver had stepped away from the table. Every analyst, every trader, every voice in the financial community expected the same thing. Without China in the room, metals would struggle, silver would drift, the price would soften. That is what the conventional logic said. That is what the models predicted. That is what the crowd believed. The market had other plans. By Friday's close, silver had moved nearly 9% higher. Futures printed 84.57. Gold reclaimed 5,100 hours. Both moved with authority. Both moved without the participation of the single largest demand engine on the planet. And that is where the serious analyst stops. Not to celebrate the move, not to chase the number, but to ask the only question that actually matters in moments like this. If silver just did this with China out, what happens when China comes back? Tuesday is not just another trading day. Tuesday is the day the Shanghai Gold Exchange reopens. Tuesday is the day Chinese industrials, Chinese institutions, and Chinese retail participants re-enter a market that moved significantly while they were away. They will open their screens, they will see the price, and they will respond. But here's what most people watching from the outside do not yet understand. China did not go completely dark during the holiday. The physical market never fully sleeps. And what was happening inside China's physical silver market during the silence tells a story that the futures price has not yet told. In Shenzhen, one of China's primary precious metals trading hubs, the largest silver recycling company was offering the equivalent of $93 per ounce to buy back 99999 pure silver. That was the physical bid. That was the price the real buyers were willing to pay. Not on a futures screen, not on paper. In physical metal with their own exchange still closed. Western futures were at $84. Shanghai spot was already running at $86. 3 different prices. Same metal, same moment. That gap is not a glitch. That gap is a signal. And Tuesday is when the signal becomes undeniable. There is a word that governments fear. Corporations avoid it, and markets eventually cannot escape it. That word is deficit, not a budget deficit, not a trade deficit, a physical one, the kind where the world is consuming something faster than the earth can produce it. And in silver, that reality has been quietly building for 6 consecutive years. Most people think of silver as jewelry, as coins, as something sitting in a safe somewhere collecting dust. That picture is outdated, dangerously outdated. Today, silver sits at the center of the modern industrial economy in a way that very few commodities can match. Solar panels, electric vehicles, semiconductors, medical equipment, defense systems. Every single one of these industries depends on silver at a level that cannot be substituted, cannot be replaced, and cannot be negotiated away, and the world is not producing enough of it. Annual global mine production sits at approximately 800 million ounces. That number sounds large until the projections for 2026 are placed beside it. The deficit approaching the market is estimated at nearly 300 million ounces. That means more than 1/3 of everything the world pulls from the ground in an entire year. Still will not be enough to meet demand. Read that again slowly. 1/3. Not a rounding error, not an analyst's footnote. A structural failure that has been building year after year while paper markets have been covering the gap with financial instruments, forwards, leases, and rehypothecation. Complicated words for a simple concept. Borrow from tomorrow to pay for today, and keep doing it until tomorrow arrives. Tomorrow is arriving. Here is what makes this deficit different from every other commodity shortage story told over the past 2 decades. Silver is not facing a demand problem. Demand is not slowing, it is accelerating. The green energy transition alone has created an industrial appetite for silver that was not part of any supply model written 5 years ago. Solar panel manufacturers, electric vehicle producers, and grid-scale battery systems are consuming silver at a rate that mining operations, even running at full capacity, cannot match. And mines do not scale overnight. A new silver mine takes 7 to 10 years from discovery to production. The supply response that markets are waiting for has not started yet, so the deficit does not shrink next year, it grows. And the paper structure built on top of a shrinking physical foundation can only hold for so long. There is a moment in every structure when the weight becomes too much, not gradually, not with warning, all at once. And the people standing underneath it are always the last ones to look up. Right now, inside the COMEX futures market, a number sits quietly on a spreadsheet. Most people scroll past it. The ones who understand it cannot sleep. Here's the number. March contract open interest in silver currently stands at approximately 222 million ounces. That is the theoretical obligation. That is the paper promise. The amount of silver that, if every contract holder demanded physical delivery, the market would be required to produce. Now here is the other number. Registered silver, the metal that is genuinely available, warrant issued, and ready for physical delivery against those futures contracts, sits at 88.19 million ounces. Subtract one from the other. The gap is over 130 million ounces. 130 million ounces of silver that is theoretically owed, that does not physically exist in the deliverable pool. In normal market conditions, this gap does not become a crisis. Because most futures contracts are never taken to delivery, traders roll their positions forward, they move from March to May, they take their profit or their loss in cash and walk away. The system depends on this behavior. It was designed around this behavior. But rolling takes time, and time is exactly what this market does not have. With 4 trading days remaining before the March contract enters settlement, the roll pace has been dangerously slow. Only 15 million ounces rolled in a single session. The mathematics of what remains against the days available does not produce a comfortable outcome. And while this quiet crisis builds inside the roll schedule, not a single ounce of new metal has entered the registered pool. No inflow, no replacement, no cushion being rebuilt. Eligible silver, the broader inventory sitting in vaults but not immediately available for delivery, continued shrinking. Another 1.2 million ounces left eligible storage in a single session. The total COMEX inventory is seeing net outflow even as the registered figure holds flat. This is what a structural squeeze looks like before it becomes visible to the public. The pressure does not announce itself, it simply builds. Until one morning, a contract holder decides not to roll. They decide to stand for delivery instead. And the 130 million ounce gap stops being a spreadsheet problem and becomes a market event. Price is not always truth. Sometimes, price is just the last number 2 people agreed on, in a room that does not represent the whole world. And right now, 2 very different rooms are looking at the same metal and seeing 2 completely different realities. In the West, the screen says $84. In Shanghai, spot was already trading at $86. And in Shenzhen, a single physical bid from the largest silver recycling company in the region was sitting quietly at $93. Same metal, same moment, 3 different prices. Most people see a price on a screen and accept it as fact. That is how financial markets have trained the general public to think. The number on the futures board is the number. Everything else is noise. But serious market analysts understand something different. Futures prices represent paper agreements about future delivery. Physical prices represent what real buyers in real markets with real industrial need are actually willing to pay today. When those 2 numbers begin to separate significantly, the futures price is not correcting the physical price. The physical price is telling the futures market where it is actually going. And right now, that gap is $9. Consider what that $93 bid actually represents. This was not a retail investor panicking. This was not speculative fever. This was a major industrial recycler in one of China's primary precious metals trading hubs, offering to buy back $999.99 pure silver at a price nearly 11% above what Western futures were showing, with their own exchange still closed. During a national holiday. That is not emotion. That is desperation dressed in professional language. Chinese industrials need silver, not as an investment, not as a hedge, as a raw material that their production lines cannot operate without. Solar panel manufacturers cannot substitute away from silver. Electronics producers cannot find an alternative. The demand is not discretionary, it is structural. And when structural demand meets a physically constrained supply, price does not negotiate politely. It moves. Now place that $93 physical bid inside the context of Tuesday's reopening. Shanghai Gold Exchange comes back online. Chinese institutional buyers re-enter the market. They see Western futures at $84. They see the premium that already existed before their holiday ended. And they do what any rational buyer does when they find a market offering something below what they know it is actually worth. They buy. Not slowly, not carefully. With the full weight of suppressed demand. That's been an entire week building pressure behind a closed door. And Tuesday, that door opens. Most people watch a price move and see a number. The experienced analyst watches the same move and sees a chessboard, every piece positioned deliberately, every sacrifice calculated, every move a message. What happened in the silver market over the past several months was not a commodity story. It was a war, fought not with weapons, but with vaults, contracts, and controlled supply chains. It began with a pattern that looked innocent from the outside. China had spent years buying silver on every dip, patiently, systematically. Every time prices pulled back, Chinese industrials treated it as an opportunity. Cheap silver was expected, cheap silver was relied upon, and that reliance quietly became a vulnerability because someone on the other side of that trade was watching. When JP Morgan pulled 13 million ounces off COMEX registered inventory and reclassified it to eligible status, it did not make headlines. It rarely does. On paper, it was an administrative adjustment, a routine vault reclassification. But what it actually did was remove 13 million ounces from the deliverable pool at the precise moment a Chinese industrial was attempting to hedge its short position on COMEX and stand for physical delivery. The silver was not available. The message was received. What followed was not confusion. It was a short squeeze of significant proportion. China went limit up as short covering orders hit a market that had no depth to absorb them. The price moved violently, and the Chinese industrial that needed lower prices to survive found itself trapped. But the story does not end there. JP Morgan spent the following weeks quietly solving the problem it had created. Silver concentrate was pulled from Latin American mining operations. Supply chains that normally served regional buyers were redirected. And when Chinese buyers attempted to source the same material directly, approaching Latin American producers with offers of $80 per ounce, a full $10 above prevailing market prices, the answer they received was consistent. The supply was already contracted. One Latin American producer confirmed the sequence directly. JP Morgan had arrived first. The premium Chinese buyers were offering was irrelevant. The metal was already spoken for. This is not speculation. This is documented market behavior from refining sources and supply chain participants who watched it happen in real time. Vince Lancy, publisher of the Goldfix newsletter, framed it precisely. This is not a metal story, it is a proxy war. JP Morgan operating as an extension of Federal Reserve interests, the PEOC executing through its own market representatives. And silver, serving as the battlefield where two of the world's most powerful financial systems are settling something much larger than a commodity dispute. Every system has a backstop, a hidden buffer, a quiet mechanism that absorbs pressure before the pressure becomes visible. For decades, the silver market had one. It was called the Interdealer Lending Network, and last year, it stopped working. To understand what happened inside the London Bullion Market Association, it is important to first understand what the LBMA actually does. Most people have never heard of it. Most people in business have never needed to. But every single price move in global silver, every futures contract, every industrial hedge, every central bank transaction involving silver passes through the gravitational field of what happens in London. The LBMA is the hub, the center of the global silver lending market, and at its core sits a mechanism that has functioned quietly for decades. Banks lend silver to each other internally, within the network, behind closed doors. When one institution needs silver to cover a delivery obligation, another institution inside the network provides it. The system absorbs pressure before that pressure ever reaches the public market. It is a cushion. And cushions have a limit. When lease rates inside the LBMA exploded, it did not happen because of a single dramatic event. It happened because the cushion ran out. The interdealer network that had been lending silver internally for years suddenly had nothing left to lend. Banks that had always borrowed from each other quietly were forced to go public. They had to advertise openly to the broader market, offering elevated lease rates to attract silver from outside the network because the supply inside the network was exhausted. That moment is not a forecast. It is not an analyst's projection. It is a documented market event that occurred in plain sight for anyone tracking LBMA lease rate history. And what it means structurally is more significant than most commentators have acknowledged. When the informal cushion disappears, the market loses its ability to quietly absorb delivery stress. Every future squeeze, every delivery demand, every roll failure now hits the visible market directly. There is no longer a hidden buffer standing between paper obligations and physical reality. Howard Marks wrote in Mastering the Market Cycle that the most dangerous moment in any asset cycle is not when prices are falling. It is when the liquidity structures built around an asset are forced to confront physical reality without the mechanisms that previously protected them. The LBMA lease rate explosion was precisely that moment. The cushion is gone. The paper structure that spent decades absorbing pressure quietly now has nothing left to absorb with. And every obligation that comes due from this point forward meets the market exactly as it is, raw, exposed, and running out of time. Every war has two fronts, one that everyone watches, and one that actually decides the outcome. The silver price is the front everyone watches. But beneath it, a currency battle is quietly deciding everything. While silver was printing $84 with China absent from the market, something else was happening that most analysts mentioned briefly and then moved past. The yuan strengthened to its most powerful level against the dollar since May of 2023. Most headlines treated it as a footnote. It is not a footnote. It is the story beneath the story. To understand why, it is necessary to step back from the silver market entirely for a moment and look at what currency movements actually communicate at the institutional level. When the yuan strengthens significantly against the dollar, it does not happen accidentally. It does not happen because of sentiment. It happens because capital is moving, because decisions are being made at levels above the trading desk, because the relationship between the world's two largest economies is expressing itself not through statements or press conferences, but through the price of money itself. A stronger yuan carries a specific implication for silver. On the surface, it appears to create headwinds. A stronger yuan theoretically reduces the hedging incentive for Chinese buyers because their purchasing power in dollar-denominated markets has increased. The import premium dynamics that drive aggressive Chinese silver buying can soften at the margin when the currency relationship shifts. That is the honest countercase, and it deserves to be stated clearly. But here is what the countercase does not capture. A yuan at its strongest level since May 2023 also signals something far more significant for serious capital observers. It signals that China is not defending a weak position. It signals that capital flows are moving in a direction that strengthens the Chinese monetary position precisely at the moment when dollar-denominated reserve systems are facing their own structural pressures. Gold above $5,100 with China offline is not a metal story. It is a reserve story. It is institutional capital, sovereign wealth, and central bank allocation quietly communicating that confidence in the dollar-denominated system is not what official statements suggest it is. Silver sits directly inside that dynamic, because silver is not just an industrial metal anymore. It never truly was. It is money that the system spent 50 years convincing the public to forget. The 1974 declassified U.S. Embassy cable confirmed openly what serious historians already understood. A large gold futures market would make physical trading seem insignificant. It would amplify volatility, discourage long-term holding, and let sentiment do the suppression work that direct intervention could never sustain indefinitely. They understood the psychology half a century ago. Flood the market with paper, amplify every dip, and wait for the public to sell itself out of its own protection. But capital at the sovereign level never forgot. China never forgot. And as the yuan strengthens and gold holds above $5,100 without Chinese participation, and silver trades at $84 with a $93 physical bid sitting quietly in Shenzhen, the message being sent through currency markets is the same message being sent through vault reports, through lease rates, through roll schedules, and through every number this entire documentary has examined. The dollar-denominated paper structure is not the final word on value anymore. And the capital that matters most figured that out long before the headlines did. Everything examined in this documentary, every vault report, every lease rate, every currency signal, every physical bid, every roll failure, every proxy move on every chessboard, all of it converges on a single point. Tuesday, Shanghai reopens, and the market that has not seen Tuesday yet is about to. When the Shanghai Gold Exchange comes back online, it will not open into a neutral environment. It will open into a market that moved 9% during its absence. It will open with Western futures sitting at $84, while physical bids inside China were already running at $93. It will open with COMEX registered silver unchanged, no new metal in the deliverable pool, and a March settlement window that has days remaining, and a roll pace that cannot mathematically resolve itself quietly. It will open into everything this documentary has documented, and Chinese institutional buyers, industrial hedgers, and sovereign-level participants will look at their screens, and they will act, not emotionally, not reactively, with the full weight of suppressed demand that spent an entire week building behind a closed door. The unresolved question that serious analysts must sit with is precise. Will the COMEX March settlement produce a genuine delivery demand that the current registered inventory cannot absorb? The mathematics between 222 million ounces of open interest and 88 million ounces of registered silver does not close quietly under normal conditions. Under current conditions, with eligible inventory draining, lease rates elevated, the interdealer lending cushion exhausted, and Chinese physical demand re-entering at a premium. The conditions are not normal. They have not been normal for a long time. The silver market was structurally built to function under $30 per ounce. Every supply chain participant, every industrial contract, every hedging model, every vault arrangement was designed around that assumption. The market is now operating at nearly 3 times that level. And the physical demand underneath it is not speculative. It is not momentum driven. It is structural industrial necessity that does not slow because a futures price becomes inconvenient. For the business community watching this, for the entrepreneurs building in industries that touch the supply chain, for the decision makers who understand that commodity markets are not separate from the broader economic environment they operate inside, the question is not whether Tuesday matters. The question is whether the preparation happened before Tuesday arrived. Markets do not wait for understanding to catch up. They move. And the ones who read the structure before the headlines catch up are never the ones left asking what happened. The math was always there. The vault reports were always public. The lease rates were always visible. The physical bids were always real. The market has not seen Tuesday yet, but Tuesday has always been coming. Closing, Awen Ag. This has been Awen Ag. If this documentary reached you before Tuesday did, then it served its purpose. Hit subscribe, not for the channel, for the next signal. Because in this market, the next Tuesday is always closer than it appears. Invest with logic, never with fear.